rates. Foreign exchange rates we come across with respect to risk and financing overseas projects. Is it right? Now, when we have the investment what we have done in the investment appraisal at the previous stage level, we are going to carry forward, but we will have a multi-dimensional appraisal. Okay, issues to be considered. We have to consider the taxes that exist in different countries. Remittance restrictions. Most of the countries will have remittance restrictions because whatever you are earning, you have to reinvest in the same country. Is that we will have something called as, not here directly related, there is something called as foreign direct investment will be there, foreign institutional investors will be there. Okay, foreign direct investment, in every country there is as per the nation's priority, the business aspects, they will have the restrictions of how much you can invite foreign direct investment, in which sectors you have to invite, and what is the percentage. In some cases there will be 100%, in some cases there will be restricted to 75% and 50%. Remittance restrictions are there. We cannot remit the amount back to the home country, back to the country where the head office, parent company, put in that way. Is that you have intercompany flows of the cash flows, working capital will be there. This is one aspect, issues to be considered. These issues we have to write when we are analyzing question number 1. Okay, whichever is relevant to that. We have the NPV techniques, little bit more advanced. You have a APV, adjusted present value method. Okay, fine, and international CAPM. Fine. We are doing that, and financing overseas project. This is a comprehensive one, and this will be covered from here till almost chapter 7. Means if you take from chapter 1 to 7, plus or minus, those concepts will be somewhere touched in question of section A. Okay. Now, NPV and VNPV we have done. This is that we have talked about relevant cash flows. What is that liability calculation? Here we have not done. In the previous section, in the previous chapter, we have done a little bit of it. Is it we have done the depreciation, the capital allowance for the depreciation, tax relief, tax allowance on capital expense, tax allowance which you are going to get on the tax relief on the capital allowance. Okay, we have done this little bit in the previous case. We carry forward the thing, dealing with the inflation and distinguish between how we are going to treat it as money and what is the real cash flows. Okay, real cash flows means, in simple words, we will not consider depreciation. Okay. And international investments includes additional challenges when we are talking about what is the exchange rates will have impact. Double taxation, more or less the concept of double taxation has been eliminated. Okay, more or less means double taxation is eliminated. Is that we don't have double taxation within the most of the countries. But here what will happen, what they will do, they will create fictitious countries. Okay, they will create fictitious countries and they will add a concept of double taxation. Intercompany flow, management charges or the royalties. Okay, intercompany, if you have a group company, how the royalties will work from one country to another country and as well as remittance restrictions. Okay, we have 3 types of risk. Is that one is transaction risk, one is economic risk, one is translation risk. Transaction risk, translation risk, and economic risk. Another transaction, translation, and fine. Okay, transaction risk, fine. Transaction risk, transaction risk, translation and economic risk. Okay, fine. Okay, we will cover this somewhere in chapter 10. We will cover when we are talking about the hedging. Okay, when we are talking about the hedging and derivatives, we will cover those things. Fine. And when we are talking about the translation risk in terms of consolidation. Okay, with respect to with transaction risk, we are talking in terms of hedging. Okay, we are talking in terms of hedging derivatives. We will cover transaction risk. In terms of investment appraisal, we are covering the economic risk, and in terms of consolidation, we will take the translation risk. Okay, there are three types where we are going to work it out. The relationship between when we are talking about the foreign exchange rates and its impact on the investment appraisal, is it right? We will take into consideration what the inflation, interest, inflation, and spot rate and forward. Little bit we have done, okay? Little bit we have done in the financial management. Even if you take financial management, what you have done in 2022, 23, and the financial management of 2025, they have made some changes, okay? Some changes. A feature of exam questions covering international investment decision is often need to calculate the relevant exchange rates over number of years. A summary of key relationship is therefore given in a four-way equivalence table follows. Fine. Now, this is what it says. Is that we have done little bit. Okay, we have done how we have what is the concept of forward rate, spot rate, and how into Fisher effect. Okay, you can say in terms of a Fisher effect, and you are take into consideration it is a expectation theory. Any idea about this? Fisher effect talks about what? Fisher effect talks about the inflation. Is that, see what happens technically if the ground situation is, rate of interest consists of three factors. One is your real rate, one is your inflation, one is your inflation, and one is the risk factor. Is that the most important thing that matters in the rate of interest is the inflation, because inflation is going to be determined on what? It is the market based. If inflation is increasing, the rate of interest will increase. Is that rate of interest will increase? Automatically things will change. If it's nothing but if we are taking here it as a concept of I. In some other cases, we take it same concept in terms of R. If R is increasing, it will have impact on the present value. Is it right? Now, what we will do? See the things. Difference in interest rates is equal to the expected difference in inflation. Whatever the rate of inflation, okay, whatever the difference in the interest rate, assume one country is having an interest of 5%. And another country is having an interest of 7%. The difference of 2% primarily, is that the difference of 2% is primarily because of what? Because of inflation. Is that whichever country having the higher inflation, it means they will have the higher rate of interest. This is the relationship like this. Whereas this is the relation, difference in interest rate will be interest rate parity. Is that interest rate parity? What will happen? Definitely different spot rate and future forward rate. Is that you will have the spot rate as on today, and you have the forward rate. Okay, you have the forward rate. What the rule says financial management? Financial management says it is a time value of money. When we are talking about the time value of money, what will happen? The value of money will decrease. Okay, the present value will decrease. When the present value is decreasing, it has to be compensated. Is it right? It has to be compensated. It has to be compensated by a higher rate, by a differential rate of interest. Is that by the difference rate of interest? Okay, if the value, see, you are paying, that is the reason. If you take dividend growth model, okay, dividend growth model, what is the dividend growth model? We are increase the dividend year on year by 10%. The reason is the value of money will be decreased and it will be concentrated by a proportionate percentage growth in the dividend rates. This is what we are talking about, the forward rate and spot rate. Difference between the forward rate and spot rate is nothing but expected change in the spot rate. Is it expected change in the spot rate of today with the spot rate of the future, S1 into S2. These formulas, to some extent it will be provided, but more than that, even it is provided, we should have a okay, it will be part of the question paper, but more than that, we should know where we are going to apply and how it is going to be applied. Is it? Now, what they have mentioned here, they have given a small example. Okay, they have given a small example with respect to one second. Yeah, this we keep it right, these things. Is it base currency, interest rate of base currency, interest rate of counter currency, interest rate of base currency, interest rate of counter currency. Fine. Interest rate of counter. I will give like this. We have done something like this. Is it right? What we have done? P0. P1 by P0, is it? No, it is not workable here. No problem. Okay, we have taken the different the things. Okay, now what they say, the current exchange rate is given as dollar to pounds. Okay, dollar to pounds. Fine. Expected inflation. What is the relationship about to work expected rate, spot rate for a next 3 years? Okay, now purchasing power parity theory. Is it? PPT means purchasing power parity theory. Fine. Now, the current exchange rate is $1 is equal to this much pounds. Okay. Expected inflations are this much. Use the relationship above to work out the expected spot rate for the next 3 years. Is it right? For the next 3 years. Now they are saying that $1 is equal to, $1 equal to how much? 1.7025. Is that $1 equal to 1.7075? What is the spot rate formula? 1 second. Fine. One second. Yes. What they are saying that the current exchange rate is that the current exchange rate is given this much. Okay. This is buying and this is selling. Is it clear to you? 1.7025, see, and yes, bid, and this is buying, and we will see this is buying and this is selling. Okay. Fine. This is the spot rate they have mentioned. Is that what is this? This has been given as a spot rate. This is spot rate, means this is going to be S0. Is that they are asking us to calculate S1. Okay, they are asking us to calculate S1. Is that expected change in the spot rate, S1. Fine. Expected 1. Fine. Okay. Fine. See, this is the S1 is the expected spot rate. Okay, X1 is the expected spot rate. Now base currency is UK. Why it is base currency? We are comparing with $1 is equal to this much equivalency. Is that base currency is UK1. Okay, whereas the counter currency is, in other words, it is a transaction currency. Is that $1 is the counter currency with whom we are exchanging. Okay, with whom we are exchanging. What will be the equivalence of that? Okay, what is the equivalence of that? The only thing that matters to us is the only thing that matters is how we have to identify the base currency and the counter currency. Okay, base currency and the counter currency. Base currency is the equivalent, how I can say, fine, 1 second, 1 second. One second. There is a technique is there that's 1 second. Fine. That actually, see, 1 second. This is this one. Okay. Yes, 0 times 1 plus US inflation divided by 1 plus UK inflation. Is it right? 1 plus UK inflation. Okay. Now, actually we will start from here, but what they have given you the two rates they have given. Here it's not buying and selling, they have given the opening and closing. Okay, it is in different context. Okay, it is in a different context. That is the range they have given. Okay, this is the opening and this is the closing. This is the opening value, opening value, and this is the closing value. Okay, I have taken from a perspective of buying and selling. In other terms, it will be a buying and selling. Okay, fine, no problem. Here we are talking about the opening and selling. See, this is the pound rate. Fine, for $1 this is equal to pound. What they say that the UK inflation rate is 5% and the USA inflation rate is 5% and UK inflation rate is 2%. How the value of the currency will I can say will decrease, it will not increase. Okay, when there is a inflation, the value of the currency will have impact. Okay, we will pay more rather than we will pay less. If the inflation is increasing, we pay more. If inflation is decreasing, we pay less. Okay, now they have given the range. Okay, when they have given the range, what they have taken the midpoint of the quoted spread. Is it midpoint of the quoted spread? Usually sometimes they will give only one. In some cases they will give both the opening as well as closing. Is it? When they have given the quoted spread, is it right? This is going to be S0. Is it S0? What is the inflation of USA? They have given here. They have mentioned it: 5%, 3%, 4%. Is it right? Here 5%, 5%, 3%, and 4%. This is the rate of inflation. Whereas here the UK inflation is 2%, 4%, and 4%. Is it? If you take into consideration what we are calculating, we are calculating expected spot rate. Every question related to investment appraisals, will have this step. Okay, will have this step as a part of the calculation of the exchange rate. Okay, if they are going to have the investment in other countries. Okay, in other countries. Likewise, this is the basic, very basic one. We are talking about the exchange rate at the end of 1 year becomes the basis for next year calculation. Next year calculation, we will take the as appropriately. We will convert this into. We will use it for the projections of the cash flows. Okay, we will use this for the projection of the cash flows. Okay, now how it has been given Here they have see now the spot exchange rate is how much? The spot exchange rate is 1.5352 euro, 1.5352 pound 1. Okay, they have given the inflation. Is that they have given the inflation with respect to Europe as well as with respect to UK. Okay, now which one here first we have to make which one is the home currency and which one is the counter currency. Is it which one is the home currency and which one is the counter currency? One second, I'm here. One second.